Hi, I'm Bob Jaswinski, the founder and president of JFS Wealth Advisors. Thank you for taking the time to view this video, our review of the financial markets at the end of 2014 and beginning of 2015. We developed this first chart in 2009 to help in describing the long-term cycles of the stock market. After the large stock market decline in 2008 and 2009, during which the S&P 500 index declined by 51%, global stock prices made a huge recovery, increasing by an average annual 18% per year for the 5 years through 2013. Even when considering the more modest return of 4.6% in 2014 from global equities, the average annual return was 15.6% for the 6 years through 2014. This performance of the global equities markets over the last 6 years is very consistent with performance after prior stock market corrections. Since 1973, we are defining 5 stock market cycles, periods which began with a decline in the S&P 500 index of 15% or greater. We believe that global stock markets can continue to increase. However, we do expect global stock market volatility to be greater than the recent past, producing more ups and downs in stock prices. This chart shows that most prior stock market cycles have not stopped at average valuations, which is where we believe we currently are. Valuations are measured by price-earnings multiples, how much investors in the aggregate are willing to pay for $1 of corporate earnings. Some strategists believe price-earnings multiples can continue to increase, especially considering current low interest rates. Corporate earnings are expected to continue to increase and could also drive stock prices higher. During 2014, the S&P 500 index, measuring U.S. large companies, generated a total return of 13.7%. This was significantly higher than returns from other major stock asset classes. The Russell 2000 index, measuring U.S. small companies, generated a much lower total return of 4.9%. Stocks in foreign developed markets produced a negative return of 4.5%, as did stocks in emerging markets with a negative 1.8%. Our JFS Global Equity Blended Index generated a total return of 5.2% for 2014. Average annual returns for the last 3 and 5 years, including 2014, were much higher at 15.9% and 11.3% respectively. The decline in foreign developed markets was caused by the dollar increasing in value against most major foreign currencies. Foreign developed markets generated a 6.4% return in local currencies. The decline in emerging markets was also caused by the dollar increasing in value. Emerging markets generated a 5.6% return in local currencies. During 2014, short-term interest rates increased slightly, but long-term interest rates declined. When interest rates decline, the value of bonds generally increases, increasing the total return from bonds. Of course, this is a double-edged sword, as when interest rates begin to increase, the value of bonds declines, reducing the total return from bonds. We could see negative total returns from bonds once interest rates begin to increase. There are many pressures throughout the world that will likely cause interest rates to remain lower for longer than most expected over the last few years. Very low interest rates in Japan and Europe, the stronger United States dollar, and lower commodity prices, including oil, are some of the factors that could delay the start of sustainable interest rate increases. Eventually, though, interest rates will start to increase, and that will probably be due to increasing awareness that global economic growth is not as bad as some currently fear. So, why should we still be interested in diversifying our stock investments across the world? Today, the United States stock market represents about 51% of global stock market capitalization. Foreign developed markets represent about 38%, and emerging markets represent about 11%. There are many investment opportunities outside of the United States. Investing in markets outside the United States present ways to protect against inflation and against the United States dollar declining in value, as well as to capitalize on opportunities to own investments in regions of the world that are growing faster than the United States. Our JFS Blended Global Equities Index consists of 42% in the S&P 500 Index, 18% in the Russell 2000 Index, 27% in the Europe, Australasia, Far East Index, and 13% in the Emerging Markets Index. This chart of total return shows the performance of the indexes during each of the last 10 years and the average annual return for the entire 10-year period. The best performing index for each period is highlighted in yellow. The S&P 500 index was the best performing index in only 2 of the last 10 years, 2011 and 2014. The Russell 2000 index was the best performing index in 3 of the last 10 years and produced a slightly higher average annual return over the entire 10 years. Emerging markets generated the best performing returns in 5 of the last 10 years and also produced the best average annual return over the entire 10 years. Based on current stock market valuations and other factors, we believe foreign developed and emerging markets are likely to produce higher returns over the next 5 to 10 years. This chart shows the value of $1 invested in each of the indexes and our blended index over the last 10 years. Note the blended index, representing global stock market diversification, produced a greater wealth accumulation than the S&P 500 index through 2013. We believe the benefits of global diversification will continue into the future. This chart shows the growth in $1 and the long-term benefits of maintaining discipline to a globally diversified investment strategy. Over the last 43 years, many events, both negative and positive, have impacted our global economy. Yet, globally diversified investors have been solidly rewarded over time. We appreciate your taking the time to view this video. As always, please feel free to call me or your lead advisor if you have questions or desire discussion. Our last 2 quarterly global economic and financial market reviews, posted in July and October, are still on our website. They continue to be relevant if you desire additional information on how we view current opportunities and risks in the global economy. My JFS associates and I wish you a very good and prosperous 2015.